Shall we
Good
start?
morning, everyone, and welcome to another episode of our Algates webinar series. So today we'll be discussing about a complex but interesting topic, that is buying an option. I use the word complex, but that's we are trying to make it as simple as possible for you. So before we start, I would like to introduce ourselves. So I'm Tarun Narakumar. I work as a relationship manager at Algates Financials. So we have Mrs. Nidhi Verma, who's the director at Algates Financials. So, hi, ma'am. So, what would you like to talk about the topic today?
Good morning, everyone, and thank you for joining in on a Saturday morning and giving us time. We really appreciate that. And let's begin. The what we are going to discuss today is how we are going to know which strategy to use when it comes to buying options. And then we'll jump on to the strike prices and expiry dates and how you can decide which one to choose. Then we'll take a look at the exercise and why exercise is important and when it comes into play. And later on, we will look at the liquidity and other option pricing factors which can affect your decision making when it comes to buying options or doing any other option strategy. And the last thing would be we'll see how you can place the order wherever you are having the account, how you can place the order, how you can get started with options. So this is what we have on agenda today, Tarun.
Okay. So, talking about strategy, ma'am, what are the different strategies that one can use? Like, of course, all strategies are not going to work all the time. So, what are the situations which those different strategies will work?
Okay, so first I would like to say that why do we do options? Like, why not just do those plain stocks and just buy or sell stocks and make the best out of stock market? Why do we do options? So obviously there are a lot of factors. There are a lot of reasons for people to do options, to trade in options, and they have their own advantages, and that is why options are useful instruments. So we'll look at like how options are more useful and in what scenarios they can be used to get some favor out of whatever is the market outlook we think is going to play out in the future. So uh, first let us just look at what are options, because I mean, someone who is completely new to options, for them it might get little complicated. So first we'll just discuss for a couple of minutes what exactly options are. So options are basically contracts, and they are like any other contracts. And the options, as an option holder, if you are buying an option, then you become an option holder, and as an option holder you buy yourself a right. And what is that right? Suppose you're buying a call option, then you have the right to buy the underlying stock or underlying index if you're buying an index option. So if you have a call option, if you are a holder of a call option, then you have got the right to buy that underlying stock at a definite price and at a definite time. So these are the things which are already mentioned in the contract. These are the terms and conditions of the option contract. And similarly, if you are having a put option, if you are a put option holder, that option gives you the right to sell that underlying stock at a particular date and at a particular price. So these are basically options. These are the contracts, and as any other contracts, they have expiry dates. So these are basically decaying assets. Okay, so they are not going to exist forever. They come with an expiry date. So as we talk about call option, so call option gives you the right to buy an underlying asset. So what does that mean? That means that if suppose as an option holder you have the right to buy an asset, and the asset is actually trading at a particular price, and you have the right to buy that asset at a price which is lower than its market price, then that means that that option is giving you an intrinsic value, right? And suppose when you think that the market is going to be market is going to be, you are bullish about the market and you have a bullish outlook towards the market or a particular stock, then you can then buying a call option can be a favorable option for you. So what you have to do is here is that when you are buying an option, you only have to pay a very small amount, which is called premium, and you have to pay the premium for that option. And of course some charges will come, which will include commissions and taxes and other things. So by committing a very small amount, you are getting a long exposure in the market when you are buying a call option. And assume that you are not buying an option, you are bullish about the market and you are simply going to buy that particular stock itself instead of buying an option. Then what is the difference is that when you are going to buy the stock, when you buy the stock, you have to pay the whole amount, the whole price for the stock upfront before buying that stock. That amount of money should be available in your trading account. But here, buying a call option gives you the same position in the market, same exposure in the market, but the price which you have to pay is comparatively very small and very limited, which is the premium of the option. So for a very small amount, you get a greater exposure. So that is why buying an option can be beneficial when compared to buying the actual stock or actual stock in the market. Similarly, when you are buying puts, when you're buying a put option, that means that you are having a bearish outlook, because bullish is not the only outlook which one can have. So obviously, when you are having a bearish outlook, then you can buy a put option at that time. And this gives you short exposure in the market. And at the same time, obviously, it has got limited risk when it comes to the premium amount which you pay. And when compared to stocks, obviously you cannot short sell stocks for other than intraday, you cannot short sell stocks. So you cannot have short exposure for if you want to keep anything overnight. You cannot have short exposure indirectly in stocks. So when you have a bearish outlook, then these put options, buying put options gives you short exposure in the market with a very limited amount which you can commit. So yes, so it can also be used to potentially manage your portfolio or hedge your portfolio, or a single position or your entire portfolio. It can be used for that also. So suppose you are having some stocks, and then at that time you are keeping them for the longer term, and at the same time for a shorter term you have some bearish outlook, then you can also use these put options to hedge your positions. So this is what is basically about option. So now let's just look at how buying a call option can work for you and in which scenario you can use it. So suppose that the situation is that there is an XYZ stock which is trading at say rupees 263 per share at present, and you have a bullish outlook for this stock. You think that this stock is going to go up in the near future. So what you want to do is you don't want to buy the stock, because if even if you're buying a single stock, you have to commit 263 rupees. You want to commit very small amount and you want to have a limited downside risk. Then what you can do is you can buy a call option for on this stock. Say you buy a call option which is expiring in June. Okay, and the call option expiry strike price is 265. So you are actually buying XYZ June 265 call option, and assume that the price of this option is 4 rupees 20 paisa. Okay, then what happens in this scenario? What will happen? Let's have a look at the various potential scenarios which might unfold in future. So this is a profit and loss table. So this will help you understand how your profit or loss is going to unfold in the future. So what happens is that the far left column you see is the price at expiry. Okay, so price at expiry means this is the price of the underlying stock at expiry of the option. and you are already a holder of a call option. You have already bought XYZ June 265 call option, and the price that which you have paid for that option is 4 rupees 20 paisa. Now suppose at expiry at the end of June, the price of this XYZ stock is 280 rupees. Then what happens in this scenario? Obviously your option cost is only 4 rupees 20 paisa. Then what is the value of this option at expiry? See, think of it in terms of would you rather, think in that those terms. What you have is an option, is a call option. And what does that option say? That you have the right to buy the underlying asset, that is XYZ, stock of XYZ at 265 rupees, right? So the price of the stock is actually 280. So what you would do in this scenario? You would obviously go in and jump on to the stock and buy it immediately at 265 rupees, and you can then sell it at the market at 280 rupees, and you make a profit of, you make like 15 rupees instantly. So value of this stock is actually 15 rupees. So how much profit or loss do you make from this trade? So you have 15 rupees value of the option, and you paid 4.2 rupees as the cost of option. So your actual profit is turning out to be 10 rupees 80 paisa. Now suppose that the value of the stock, the price of the stock, same stock, is actually 270 rupees. Then what happens in that scenario? Now you have the option to buy the stock at 265 through your option, call option. Okay, so you will immediately go and buy that stock, obviously, because you have the right, you are the holder of the option and you have the right to buy at 265, and you will sell the same stock in the market at 270 because that is the market price of the stock at expiry. So you make 5 rupees in that trade. Okay, so overall in the option trade, how much do you make? The value of the option at expiry is 5 rupees, and the cost of the option again is same 4.20. So you make 80 paisa from that trade overall. So now, if where is the break even in this? What happens when the stock price at expiry is 269.20? Here actually the value of the option at expiry will be exactly same as the price you paid for the option, which is 4.20. So this is your break even point, right? This is your break even point for this trade. So you would definitely want your trade to be, this is not a favorable position, obviously. You would not want, you would want the stock to be going little up so that you make some profit from the trade. So let's see what happens if the stock price is lesser than that. If the stock price is say 265 or 260 or 255, what happens in these scenarios? What exactly happens is that you have the right to buy the stock at 265 and the price of the stock actually is 265. So it doesn't make any difference to you. So you will obviously not exercise this option, right? Because option gives you the option to buy stock. You don't have to, you are not under any obligation to buy the stock. So you will obviously not exercise the option. Okay, so your option is not exercised. So what you lose here is the entire premium which you paid for the option when you bought it. And similarly, when the stock price goes even down like 260 or 255, your option will expire worthless. It will have zero value, and then your loss will be the entire premium which you paid, which is 4 rupees 20 paisa in this case. So you see here what happens here exactly is that the wherever the price is below after a certain point, wherever the price goes, your loss is actually limited to 4 rupees 20 paisa. And when in case the price of the stock goes up, okay, then in those scenarios you are making profits, okay, from this trade. So the further the price goes up of the underlying stock, you make more profit. So let's just look at it in the diagram form so that we understand it better, because diagrams are always more useful in understanding. So what you have bought is XYZ June 265 call option at 4 rupees 20 paisa. And on the right hand side, you see the diagram, which is your profit and loss diagram. So you see the blue line, which is indicating your profit and loss in different scenarios. On the x-axis, it is the price of the underlying stock at expiry, and on the y-axis is charted your profit and loss. So you see wherever the price goes, the price of the stock goes, your loss is actually limited to 4 rupees. To be precise, 4 rupees 20 paisa. So here is the blue line, which is the horizontal line, which you can see, and your break even point comes where there is a kink in the hinge in the line. So that is around 265 rupees. And from there on, what happens is that the further the price goes up, you make more money on that trade, right? So sorry, the break even point is coming at around 269 rupees, not 265. So there is a hinge at 265, but at 269 there is a break even point. And beyond that, if the price of the stock goes beyond that, the further it goes, the more profit you make. So this is the benefit of buying a call option, compared to vis-a-vis when you buy a stock directly. In stock, what happens is that when the stock price moves, the movement in your profit and loss is also correlated to the movement of stock price. Here it is correlated, but then what is happening is your loss is limited, and the correlation is not exactly one when it is on the favorable side. So this is what an option holder can get through buying a call option, Tarun.
Okay, so great, ma'am. Till now we learned what is call option and like it works only when there's an underlying stock in price increases. So what about put option? Can you please elaborate on that? When does that work?
Yeah, so put option is same as call option, but it works in a little opposite way. So we will think of buying put option when we have bearish outlook, as I told earlier, because the put option gives the option holder the right to sell the underlying stock, as opposed to right to buy in the price option, in the call option. So when you have the right to sell, then what you would do, we will look at it in the same way. We will look at different scenarios and we'll see how it plays out. So here also you have to pay the premium for buying the option. If you're buying any option, obviously you have to pay the upfront premium for that. And similar to call option, you have limited risk, because you know that you have already paid an amount of premium, and that is the maximum loss which you can have on that trade. Okay, so the maximum loss is already defined, and the maximum profit potential is unlimited in buying an option. So let's look at how it plays out for a put option in different scenarios. So again, same situation. You have a stock XYZ, it is trading at 263 rupees. And it is not bullish, it is bearish, so there is a typo error. So you are bearish on the stock, and you want limited downside risk. So what you do is you buy a put option. So you're buying a June 265 put option, and the price for this option is now 5 rupees 90 paisa. Okay, so what happens here is, when again on the extreme left is the price of the stock at expiry. So now what happens is that when the price of the stock is at 270, what is happening here is you have the right to sell the underlying stock, right? So what will happen at expiry? Think of that. What will happen at expiry? What would you do? What would be favorable for you? Think in those terms. You have the right to sell at 265, and the price of the stock is already 270. So obviously you will not sell at 265, right? And you will not exercise that option, that means, and your option will expire worthless. Same when it is 265 rupees, then the market price is also 265, and you have the right to sell also at 265. So it is practically worthless to exercise the option. So the value of the option at expiry in these two scenarios is zero. And when the stock price goes to 260 at the time of expiry, what you would do in this scenario? You have the right to sell at 265. So what you would do is you will immediately buy at 260 and sell at 265 through your option and make 5 rupees, right? So the value of the option at expiry in this scenario is 5 rupees, but still you see that you paid 5.90 for your option upfront. So ultimately you are paying 5.90 and you are making 5 rupees. That means you are ultimately in loss of 90 paisa, right? Now what happens, where does the break even come? When the stock price is 259.10, right? Then in this scenario the value of the contract, the option contract is exactly 5.90. So here is your break even point for this trade. And if the stock price ends up anywhere below this price, okay, anywhere below this price of 259.10, then you make profit on this trade if you are keeping this option till expiry. Okay, see, when the price is 255, then what would happen is that obviously the price of the stock in the market is 255 and you have the option to sell the stock at 265 through your put option. So you will immediately go and sell it at 10 rupees higher. Okay, so you make 10 rupees from the option and 5.9 is what you paid. So ultimately from that trade at expiry, you are making 4 rupees 10 paisa. So further the value goes down, the further the value goes down for the underlying stock, you make more and more money from this trade, right? So what happens in a put option is ultimately that if the stock price goes down, you as an option holder make more money. That situation is favorable for you. And when the stock price goes up, in those situations you end up making loss, which is not what you intend to do. So that is why you should buy a put option when you believe that the underlying stock is going to go down, when your outlook is bearish on that stock. So again, same thing, we look at the profit and loss diagram because these are very useful to, rather than looking at a big chart and understanding each and every row, diagrams are more useful because they give you a visualization, right? That how my profit and loss is going to play out in future. So that is why you should try to understand the diagrams. They can be little overwhelming when you just start, but once you start understanding them, you will find them very useful. So here is again the diagram for put option, and you see how it is playing out. When the price of the underlying stock is going down, your option, profit from the option trade is increasing, and when it is going down, then of course it is decreasing, and after a point comes where your loss is limited to whatever price you paid for the option, right? So hope this helps for people who are new to options to understand in a better way, and they can visualize what is happening when they are doing option trading.
Yes, ma'am. So, okay, ma'am. So, if you assume I'm a trader, so and I've decided on a particular strategy regarding, with a certain outlook which I have on the market. So, but then I'm trying to buy a call option, then I see a lot of strike prices. So, here I get confused. Like, how do I decide which strike price to go ahead with?
Yeah, options are very confusing because within options you have lot of options as a trader, right? You have lot of strike prices and expiry dates. So it is very important to choose them correctly. But please understand that there is no wrong or right answer for this. It is something what you believe in and what works best for you, what is your understanding of the market and the underlying stock. So it depends on you, nothing is right or wrong here. So the strike price is actually, let's just look at the plain definition. So the strike price is the price per share for which the underlying security may be purchased in case of a call or sold in case of a put by the option holder upon exercise of the option, right? So this is the price which is fixed, and at this price you as an option holder can buy or sell the underlying stock at expiry. So this is predefined. Okay, and when you are going in an option chain, you will see there are a lot of options available. So we will look into it more detail in the more detail in a few minutes. And of course, expiry date is the last date on which you can exercise your option. So this is the date till which your option is a valid contract. Okay, after this, whether you do anything or not, your option ceases to exist. Okay, as I told earlier that these are contracts, these are not like normal stocks. Options are not like normal stocks, so they decay, they are decaying assets, and after a point they cease to exist. Okay, so expiry date is the date when your option ceases to exist. It has basically, after that it has no value. Okay, so strike selection is important because it determines the moneyness of an option. So we will look at what is moneyness and what do we mean by that. See, in options you are paying a premium, right? So why you are paying that premium actually? Why a person, why an option holder is paying a premium upfront to buy an option? Because obviously it is giving you an option, it is giving you a right, okay, to do something in the future at a predefined price and date. So for that option, for that right, you have to pay something, right? You cannot get it for free. And other than that, there is one more thing. There is an intrinsic value in the option. What is that intrinsic value? Suppose we look at the previous example of our XYZ, the hypothetical example. So we assume that the underlying stock was trading at rupees 263, and we bought a call option with a strike price of 265, right? So in this case, what is happening? In this case, the underlying stock is trading at 263 rupees, and you are buying a call option saying that the strike price is 265 rupees, and you have the right to buy that underlying stock at 265 at a future date. Okay, so in this case, what is happening? The current price of the stock is 263 and your strike price is 265. And so if the price of the stock is 263 rupees, would you rather go and buy the stock at 265 through that option? Obviously no, because it is the market price is 2 rupees lesser than your strike price, right? So you will not buy that option. So here the intrinsic value in that option is zero, because at this point in time you do not have any value in that option, any intrinsic value in that option. Now suppose that the price of that same underlying stock is 270 rupees. Okay, the market price of the same underlying stock is 270 rupees, and you have the right to buy that stock through your option at 265. You have chosen the strike price of 265. So what will happen? The price of the stock is 270, and you have the right to buy at 265 through your call option. So you will obviously jump in and say, okay, let me buy at 265 because I am getting something at 265 for which the actual market price is 270, right? So the inherent value of that option at that time itself, the intrinsic value is 5 rupees, because instantly you can make 5 rupees, right, from that. So that is called the intrinsic value of that option. Basically, it is the difference between the market price of the underlying stock and your strike price. So in the call option, if the market price is higher, then and the strike price is lesser, that means the market price is higher than the strike price, then the option is already having some intrinsic value, and then that option is called in the money. Those options which already have some intrinsic value are called in the money options, and obviously the premium which you will be paying for those options will be little higher when compared to premiums which you are paying for out of the money. So out of the money the contrast of in the money. In out of the money option, we have no intrinsic value, like we discussed earlier. In the call option, when you are having the market price at 263 and your strike price is 265, obviously that option doesn't have any intrinsic value. So that option is called out of the money option, and it will only have time value, which we will come to later. So it will not have any intrinsic value, so the premiums for these options will be lesser. And somewhere in the middle is at the money. At the money means that your strike price and your market price of the option both are the strike price is very near to the market price, or it is same as market price. So those options are at the money options, and they are in between in the money and out of the money. So which one you are going to choose depends on how you are going to, what you believe, and how you are going to what is your risk appetite, and how you are going to think that how the underlying stock is going to move in the future. Because for in the money option, what is happening is you pay a very high premium. Okay. So you have to commit more money, and for out of the money options you have to commit lesser money. But out of the money options are, as you said, they have no intrinsic value. So with time, if they do not gain that intrinsic value, then your options expire worthless, right? So that is why you need to see, you need to balance between where you want, what you want to do with your money and how you want to take it. So if you want little less risky options, then you can go for in the money. But if you think that the underlying stock is going to move very sharp in the coming days, very sharply in the coming days, so then you can just go for out of the money options and make money out of sharp movement in the underlying stock. But yes, the underlying stock has to move sharply within that time frame. So that is the risk. So there is no right or wrong answer here, but you need to consider all these things before you actually select the strike price. So when you're going to consider in the money option, when looking for option price moves that are more closely aligned to that of underlying stocks, and when you have a balanced when you are looking for balanced exposure, then you can go for at the money, and then you can make most out of time decay. And again, then when you are looking for more risk and you are expecting a sharp move, then you can go for out of the money option. So it depends on what you believe and what is your market outlook and how much you want to commit. So all these things will determine which strike price you select. But I would say that you select the strike price which is somewhere around the market price, not very far away strike prices, because when you see option chains, then there are very, very far away strike prices. So those are certainly not favorable, and there will be no liquidity, which we will come to all this later, because this is getting little complicated. Yeah.
So we talked about expiry. So what happens if an option holder doesn't square off his position till expiry? Like, does he have to exercise this option, or how does that work?
This is interesting. We already know that options are contracts and they have expiry. They come with an expiry date, and after that date, they no longer exist. Okay, but as a trader, people who are doing options, they are usually traders. They are not, I believe, investors, right? So what would happen is that there will be very few scenarios where expiry and exercise will come into picture. Okay, so what happens in expiry is that when you are obviously see what is happening here is that when you are selecting a shorter term expiry, in any option you take, you will have multiple expiries. Stock options in India have monthly expiries, and index options have weekly expiries. Nifty and bank nifty have weekly expiries. Okay, so you can, if we are talking about the stock options, we can take June expiry, or we can take July expiry, or we can take August expiry. So the more the time to expiry would be, then it would be more more longer term, option. So what happens is, when you are taking a shorter term option, then you have to pay a lower premium. Okay, so shorter term option means that suppose now we are in the month of June and we are taking a stock option which is expiring in June itself. Okay, so for those options we will have to pay lower premiums compared to if we are taking same option, everything is same, but we are taking the option which is expiring in the month of July. So simply because there is more time to expiry, there is more time to for your expectations or market situation to unfold. So the more time it has, we have to pay more premium for that. Okay, so that is why time always works against long option positions. Okay, you have more time, you have to pay higher premium. So if you are on the buying side, if you are buying an option, so that time is always working against you because there will be a time decay. Okay, so why? Because as I said, more time for outlook to play out. So we need to choose, right? What happens is that if we are taking nearer expiry shorter term options, then we have to pay lower premium, of course, but the time for play out is less, so there is more risk also. And for longer term options the risk is little lesser, but we are paying a higher premium. So that is why we should always consider these things and then choose the expiry date of which expiry date we are going to select. Okay, so reason for trade will impact the selected time frame. What is your reason why you are taking that option? Whether you want to make money out of quick movements in the underlying stock price, or whether you want to hedge your existing portfolio, or what is your purpose of taking that option, that will determine which expiry you are taking, and how much premium you are going to commit also will determine which expiry date you should select. Okay.
So how can one factor like liquidity and option pricing, should these things affect one decision, like of buying an option?
Okay, so this question, let me just talk about exercise also, because I'll just come to that, Tarun. Let me just
Okay,
talk
ma'am.
about exercise also. See, I mean, now what happens at expiry? Do you exercise your option or do you not exercise your option? So what happens is that, as I said earlier, that option traders are usually people who trade in options are short-term traders, right? So exercising an option, this scenario will be very, very rare, because before expiry, only most of the option traders will close their position or square off their position. Okay, and benefit from the movement in stock price in the prices of the option itself. But suppose you are keeping your option till expiry, right? Then ultimately what will happen is exercise will come into picture. But exercise will come into picture when your option is in the money. When at expiry your option is out of the money, then obviously it does not have any intrinsic value, it expires worthless. It has already expired, so it does not have any time value, and it is out of the money, so it does not have any intrinsic value, so it is expiring worthless. So that doesn't mean a thing. But if the option is having intrinsic value, if the option is in the money and you have not closed your option, stock options, then you have to exercise that option. So you have to be very mindful of this, especially when you are doing stock options, because in index option this will not happen, it will be settled in cash. But when you are doing stock options, then if you are keeping till expiry and if it is in the money and you are going to exercise that option, then what would happen? Suppose you are having a call option, then you will have to actually, you have the right to buy the stocks, right, underlying stocks, then you should have money to buy those stocks. And if you are having put option and it is in the money, and you're having it till expiry, then you have the right to sell the stocks, right? Then if it is in the money, then you should have the stocks to sell actually in your account, right? So keeping the option till expiry is a little tricky. So what happens is this does not come into picture for most of the times, because people will generally square off the position. But since we are doing options, I thought that we should include this and tell our viewers like what are the implications of keeping the options till expiry, especially when the options are in the money at that time. Okay, so coming to the liquidity thing which you talked about, Tarun, let's just look at what happens. So these are obviously not things which are the major things which you would consider when you are going to do options, but these are the things which you should be aware of, because these are the things which will have their own impact in trading. Okay, so it is always better to know what they are and how they are going to impact your trade. So liquidity, what is liquidity? Basically, liquidity is how easily you can buy or sell any asset. Okay, so what is bid price? Bid price is the highest price a prospective buyer is ready to pay for a security. Okay, so this is the current price at which you can sell. So if you see at the left hand side, you see there is bid quantity, bid price, ask price, ask quantity, right? So you see in the bid price and ask price there is a difference. Okay, so you see the ask price is 3.90 and bid price is 3.85. Okay, so what is ask price? It is the lowest price which a seller is ready to it is the lowest price at which a seller is ready to buy a security, right? A seller is ready to sell a security. So what happens here? At this price you can buy that option. So what is happening here is that you see there is a 5 paisa difference in bid and ask. So at the same instant, if you want to buy and sell the same option, then ultimately you are losing 5 paisa, because at the same instant, if you're buying and selling, doing both the activities, what is happening is when you're buying you're paying 3.90, and when you're selling you are getting only 3.85, right? So at the same instant, if anybody is buying and selling, theoretically if we assume, then ultimately losing 5 paisa. So if you come to the next line, which is for the next month option, the difference is becoming 20 paisa, 8.35 and 8.55. So this difference is called the bid ask spread. Okay, so if you see below in the next one for the put option, that is for the put option, so you see how it is. Bid price is 5.45 and ask price is 5.55. So the difference is 10 paisa. But then the next month option, when you go to the next month in the next line, it is 8.65 and 9.15. So the difference is increasing. It is almost 50 paisa, right? So this is the bid ask spread. What happens here is that when the bid ask spread is more, then the option can be less liquid, or you are instantly losing if you are doing both the trades at the same time, buying and selling. So this you should have in mind, because this has its own value. And I mean, see the percentage also, like the percentage, how much it comes out to, like 5 paisa of 3.85 is very small, but and then again 20 paisa when it comes to 8.35. So you have to calculate in terms of percentage also how much you are actually losing there, and you have to see. So below the 50 paisa spread is quite a big thing. Okay, so that means that those options are not very liquid, and there are not many buyers and sellers. This could imply that there are not many buyers and sellers, and that is why the spread is very high. There will always be a spread, and minimum will be 5 paisa, because ticker is 5 paisa. So there will always be a spread, but then it should not be huge. That is not very favorable. So we should go for something where the spread is lesser. So now let's look at, I have already talked about like intrinsic value and time value so much. So let's look at what these are. So already, I mean, I have told, but then we'll have just a recap for people to have better understanding. So an option, in an option contract, which is having has intrinsic value, is in the money. So as I told earlier, like let's go back to the first example. We buy a call option, okay, XYZ June expiry, 265 is the strike price. We buy that call option. Okay, suppose the current price of the underlying stock is 270 rupees. Okay, so what is happening? We have right to buy at 265 and the current price is 270. So obviously we instantly make 5 rupees, right? Because we can just buy at 265 and sell at 270, right? So 5 rupees is the intrinsic value in that option, inherent in that option at that point in time. Okay, so this is the intrinsic value. Intrinsic value will be basically the difference between the price of underlying stock and a strike price for call options. And for put options, it will be opposite. You have to take the difference between strike price and a price of the underlying stock. Okay, it should be the other way around. Okay, so strike price should be higher and the price of the stock should be lesser for put option to have intrinsic value. Okay, so this intrinsic value is a part of the premium which you pay. Okay, so for in the money option there will be intrinsic value, and for out of the money options there is no intrinsic value. Intrinsic value is zero, because suppose the current price is 263 and you are buying a 265 call option, and at that time the current price is only 263 and you have the right to buy the underlying stock at 265. So obviously that doesn't make any sense. Like that doesn't, you will not go and exercise that option and get anything, right? So at that time the intrinsic value at that point in time is zero. Okay, so in the money options have intrinsic value, out of the money options don't have any intrinsic value, and at the money options also don't have any intrinsic value. Okay, so what happens next is, out of the money options also they don't have intrinsic value. Do they come for zero? No, you have to pay some money, right? So what is that money? That rest of the money which you pay over and above intrinsic value, that is called extrinsic value of an option, and that is also called time value. So since, because you have the time, to exercise your right, for that right only you are paying the money. So the more time you have, the more time value the option will have. Okay, so the option premium will be consisting of two things: intrinsic value and time value. And in the money options have intrinsic value, out of the money options have no intrinsic value. And also one thing to be noted here is for the audience, that same option can be in the money, out of the money at different points in time. When you are buying an option, at that time an option can be out of the money. If you're keeping that option for 2-3 days, that is a call option, and the price of the stock has gone up, or something has changed, then what would happen? The same option can become in the money. Same out of the money option which you bought 2 days back can become in the money later, or same option can become, I mean, it can change other way around. So it will all depend on what is the current market price of the underlying stock. It is not only at the time of buying or at time of purchase of option, but the same option can become in the money, at the money, out of the money, depending on where the underlying stock is. Okay, so we have to consider all this. Obviously, if the option is having no intrinsic value, then obviously it is having only time value, so those options are cheaper. And premium options with intrinsic value which are in the money are expensive, and options which are deep into the money, like you are choosing a strike price such that it is deep into the money, then obviously it will have more intrinsic value, and then it will result into higher premium for those options. So we have to consider all these things when we are buying an option.
Okay, so much is happening here, ma'am. So at this moment, can we take a look at the factors which affect the price of an option?
Yes, so we already have seen that the price of the option consists of two things, which is a premium, which is consisting of two things: intrinsic value and time value. So now these are some factors which affect the price of any option at given point in time. So first is the stock price, right? So stock price, where is the underlying stock? Where is it in the money? This thing. So if the stock price is changing, then the price of the option will obviously change over the period of time. And then we have already discussed all this, but yes, just for a recap kind of thing. And time to expiry is, obviously we told you that if you have more time, for expiry of an option, then those options will be more expensive, because I mean, there is more time for outlook to play out. Okay, you have more time to exercise your right, because you're buying a right and you have that right for a longer period of time. Then for the longer period of time for which you have access to that right, you have to pay more money. Think of it in those terms, like you as an option holder have more time to exercise your right, right? So somebody says that I will give you a right only for 1 day, then for that you pay lesser money. And somebody tells you that okay, I will give you the right for 10 days, then you have to pay more money, right? Because the right is same, but only the time difference is there. So for a longer to expiry, the more time to expiry, the more expensive the option will be. And you can check it out in NSE website. Also, you can check it out in option chain. So we will look at it in some time. And then the volatility of the underlying stock is what I mean here. So if the underlying stock is more volatile, then anything can happen, right? Anything can happen at expiry. We don't know. When we are buying an option, we don't know what would happen in expiry. We only expect certain things to happen, and if they happen the way we expected, then we gain. If they don't, then we I mean, it is not a favorable position. So the underlying stock, if it is moving more frequently, if it is more volatile, then it can go anywhere, right? Then I mean, our expectations to play out, there are less chances of our expectations to play out, because simply because the stock is more volatile. So in that case also, the price of the option will be more, because what would happen is very difficult to determine. So for that uncertainty, we have to pay more amount, because yeah, there is more uncertainty, the more will be the premium for the options. Okay, so more volatile the underlying stock is, the at that point in time the options will be expensive. When you are considering the same stock option, when the stocks are less volatile in a different time period, then you will find that at those times the price of the same options will be lesser. So these are some of the factors which affect the premium which you pay for any option. So let's see, like just through this chart, what happens. So option valuations, what are the factors that affect the supply and demand for options? So what happens here is, suppose you are stock owner, okay? Stock owners get nervous. Higher expected move in the security. So they think that, okay, I mean, stock is getting very volatile. Buy options for potential protection or speculation. Then what will happen? You are already having a stock and you think that, okay, your stock might come down, and you are having a little bearish outlook for the time being. So what would happen is that you will panic, and then you will get nervous, and you will try to hedge your position. You will try to take some protection against the downside movement, or just because of speculation, you are just speculating. So then the demand for option contracts will become higher at that time. When there is more volatility, then people will think that, okay, I should buy options to protect my existing portfolio to some extent. Or when there is a lot of speculation in the market, people are thinking, okay, market will go this side, market will go upside or downside, whatever is the case, and they want to make the most out of it, the movement. Then also the demand for the option contracts will go higher, and at that time you will see that open interest in the options will be more. Okay, so buying pressure will be there, and then there will be higher implied volatility. IV is implied volatility in the options. So what is implied volatility? Implied volatility can be used as a measure of an option's relative value. Supply and demand for option contract affects implied volatility. So result will be that option will become more expensive. So option itself, like there is more trading in option, we saw that volatility and the underlying stock will make options expensive, but volatility in the options itself, the more speculation in the options, the more trading in the options itself will make options more expensive. So there is a two level effect, like ripple effect. That is what is happening. So more speculation is there in the market, then more contracts are being traded, then also implied volatility will increase and supply and demand for options will increase, and this will also affect the option prices. Okay, so now the last thing is, this is the last thing which I want to just cover, I mean, in this today's webinar. So we have to consider the time to decay. This is very important, and this affects the option prices as we come towards expiry. So time decay typically accelerates as expiry comes closer for any option. So you have bought an option and there are 15 days to expiry. So that option, if you see the next day, the time decay will be less. The next day, the time decay will be little more. The next day, the time decay will be little more. So as you are coming closer to expiry, the time decay will accelerate. Okay, shorter options have highest time decay. So here you can see in the graph, so you have 90 days to expiry, then you have more time value, of course. Okay, you have 60 days to expiry, you have time value, lot of time value. You have 30 days, then also you have lot of time value. But as soon as you're coming from 30 to 0, what is happening is that acceleration is increasing. It is coming to 0 very quickly, compared to when 90 days to 60 days, you see the line is almost horizontal, but 30 days to 0 days, you see it is almost vertical, right? So you can see from the graph that time decay is accelerating. So you buy shorter term premium, shorter term options, like options which are going to expire in next 1 week or 5 days or something, then huge time decay will be there. So you have to consider that theta decay, and you have to see that you have lesser time for outplay, and I mean your option can come to 0 very quickly. That is what makes option more risky, because of that decay, it can quickly come to 0 even before you realize, like it can become worthless, right? So there is a trick, like this is a trick in the options, that they give you the limited risk in terms of premium, but the speed with which the decay happens, especially when they are near expiry, makes them very risky, because you can lose the entire premium which you paid very quickly, right? So yeah, so now
since we learned so much about how can we actually get started and place an order to buy an option, like can you explain our viewers about it?
Yeah, see, this is basically I mean different people will have different accounts with different brokers. So I mean, it depends on what kind of interface they are giving to you, but generally just a very basic thing. So what you can do, suppose you are buying one call option, step one, equivalent to buying multiple lot size of share stock. So you need to remember this, that when you are doing options, you have to do in lot size. You cannot buy one option, you have to buy one lot. Okay, you have to do in lots, 1 lot, 2 lot, 3 lots. So there will be multiples. So suppose you think that the stock is going to go up and you are thinking of buying a call option, then what you will do, think of how much risk you can take. You're comfortable with it, and then be aware of the position size. Like, you are not just buying one, you are buying a lot. Okay, so you have to be aware of all this before you place the trade. Okay, now how you can do that? You want to start a new position, you want to buy a new option, then what you will do, you will just select that option. Then what you have to do is, you have to select the underlying stock, you have to select the strike price, you have to select the expiry, and then you have to go and buy it. Okay, depending on the interface will be obviously different for different brokers, so you have to check that out. So then you have to select all these things, and then you have to click on buy. Okay, and then you are already having an option, you have already bought an option. So what can you do to close it? What can you do to sell it? So you can just go see your positions, and there only you will get an option to simply it will not be buy, it will be close. Sorry, there are a lot of typos. So you have to just close it, or you have to square off. Okay, or you can directly go and select the same expiry, same option, same everything, and you can go and sell. You can do that way, or you can just go to open positions and just click on square off or close, whatever your interface is saying. So this is how you can just get started. And then there are orders, types of orders, which I just wanted to tell our viewers about. So there are two types of orders we will discuss: market order and limit order. So which one should you place? Because there will be options available when you place the order. So which one should you take? What is the difference? So when you place a limit order, what happens there? A limit order sets the maximum price at which you are willing to buy, okay, or the minimum price at which you are willing to sell. Suppose your option is, you are wanting to buy the option at 4.20, okay, then you place a limit order and you say that the price should be 4.20, okay. You mention the price also in the order, so that the order is executed only at that price, okay, only at that price or lesser than that when you are buying, and when you are selling, then at the same price or higher than that. So you are limiting the price in that option. So this is called limit order. So limit order will target the price. You have a target price in mind, but it will not guarantee you execution, because it will get executed or not will depend. The price of the security should come at that point. Okay, so your option can be in open trade for some time, or I mean for the whole day, depending on where you placed it. So when you place a limit order, the price is already limited, but then execution is not guaranteed. But when you place a market order, then what happens? You don't have to mention the price. Whatever is the market price, it will automatically take. Okay, so what happens is that you are not mentioning any price at this time. Okay, so you are wanting to buy at 4.20. You see that the price is 4.20 and you place the order. Okay, buying order. Then what happens is instantly the price changes to 4.30 or 4.50 and you have placed the market order. Your order will get bought at the next price, whichever is available. So here what is happening is that we do not have control over the price target, okay, but we are guaranteeing execution. Whatever is the market price, execution is guaranteed. Okay, so it will not be in open position. It will always be executed as soon as you place it. So it depends on, if you think that okay, you want to buy at market price, you can place market order. If you think that okay, I want to buy at this price only, then in that scenario you should always place market or limit order. And remember that when you are placing in huge quantities, then I would suggest that you always go for limit orders, because when you are buying in huge quantities, suppose you are buying 100 lots or 1000 lots, you are a big trader, or you are placing big quantities, huge quantities of stocks also for that matter, then at that time, suppose you are buying and you just place a market order, then at that price, whatever is available will get executed and the rest of it will keep on going. And if the price is going up, you do not have the control. Your purchase will be, or average price will go up at that time. So whenever you are placing huge quantities, it is always advisable to go for limit order. And whenever you are doing small quantities, then you can decide depending on what you want. Okay, so this was about it for today, Tarun, from my side.
So before we end today's presentation, let me quickly tell you about like what we do and what is Algates Financials. So Algates Financials, a private limited, is an authorized person of Cholamandalam Securities. So which is a leading stockbroker firm in South India. So we also deal in bonds, corporate fixed deposit, and in fixed income segments. So Algates Consulting IMF Private Limited is an insurance marketing firm. So we cater to insurance needs of our clients by providing advice on life and health insurance solutions available in the market. So we believe in providing the best service to our clients through our dedicated team of relationship managers.
So yeah, this was all from our side, from myself and Tarun today, and thank you for watching in. We have like some upcoming webinars which are mentioned in our website. So if you feel that this content is useful for you and you can make something out of it, because this is our education initiative under which we are doing these live webinars almost every month. So if you're finding it useful, please do join in, please do register. You can reach out to us, through call, email, or on our website. And thank you for watching in today again, and have a great weekend ahead. Thank you so much. It was a great pleasure.
Thank you everyone for joining today.